Hey everyone, welcome to our webinar today. I'm Andrew Stimson with Legacy Acquisitions. I'll be the host today. Today we're going to talk about the 2025 Investor Playbook, where the smart money is moving. And so we brought on some really smart guys to let us know what they see in the market, and maybe you can take something that will help you as you look at investing this year and beyond. Before we get into it, I want to introduce these three guys, and then I'll ask each of you the same intro question that you don't know is coming. So first we have Andy McMullen. He is the managing partner at Legacy Acquisitions. Yeah, he's been in this game for 25 years, and he's overseen nearly $1 billion in transactions. And Andy, tell the audience one thing about yourself that you're pretty sure they don't know.
Oh, you know what? I will challenge anybody to a Rubik's Cube competition. So I will dominate anybody. Maybe not like those young dudes that do it in like 6 seconds,
Like 10 seconds. Yeah, they're
but
like,
a
I'm
normal
done.
human. Yeah, a normal human, not an android.
Oh,
That's awesome.
nice. I wasn't ready for that one. All right, next one, Bronson Hill. He's the founder and managing member of Bronson Equity. He's raised over $50 million in the last 5 years, and he came out with a book recently. I believe it's called Fire Yourself, and he's the host of the Mailbox Money Show. Bronson, we're excited to have you on. Your turn. What's something people will not know about you?
Appreciate it. Thanks for having me here, Andrew. And yeah, so most people don't know. I was gonna make something up, but that's not as fun or as impressive. But I've actually been to 48 countries, and I love to travel. So yeah, my top country I've been to is New Zealand. If you haven't been to New Zealand, it's like it's if God had extra cool stuff, and they like creation. He just hit it at the end of the world here in New Zealand. So go there at some point. It's incredible.
Hmm. I know the one of my favorite movies is the Lord of the Rings trilogy, so a lot of that was shot there. So pretty crazy shots.
Yeah, for sure.
Very good. All right, and we've got Bryan E. Miller. Bryan is an award-winning film composer, pianist, and music producer. He's a founder of Sensory Overload Music. Oh yeah, and he's also has some cash flow coming from over 27,000 rentals. We're excited to have you on, Bryan, to share your experience over the 35 syndications you've done. Share us something about yourself that we may not know.
Okay, I'll tell you about my very first investment.
Hey, I think it's going to be hard for the. Sorry, Brian. I think it's going to be hard for the audience to understand. So we'll circle back with you.
Maybe you can
to give
turn
a
your
little.
you turn your
Yeah,
camera
you
off. If you
guys
turn your
want to go
camera
on?
off, it might help. Yeah, if you turn your camera off, maybe you can get better
Yeah.
sound.
Okay, we'll hear from Bryan soon. Let's get into this. So first question, and this is going to be for both of you. One we had is how do you protect investor capital in uncertain times while still targeting double-digit returns?
Yeah, I
Capital
think I think right
gains.
now it's been interesting if we kind of do a lay of the land here of what's happened the last 2, 3 years, specifically, excuse me, we've had the fastest increase of interest rates in over 40 years. So we've seen inflation basically go from almost nothing to now inflation is really picking up. They say it's only 3%, but it's obviously very, it's high. And so people are wondering, how do maybe I had some losses or I had some capital calls or I had some challenges the last few years. How do I protect myself from that? And so that's something we're very cognizant of going forward. We really look for a few things now. I think we're looking for deals that cash flow quickly or are already cash flowing. A lot of deals that cash flowed a few years ago were cash flowing great, and then all of a sudden, like insurance costs, labor costs, everything went up. And really, I talk about this in my book, Fire Yourself, talk about just the importance of cash flow. When you have cash flow, it does a lot of things for you. It allows you to replace income. It allows you to cover expenses. It allows you to fire yourself, right? If you have a lot of money someday, it doesn't really help you get there. So we focused a lot on cash flowing investments. It also actually reduces your risk basis in a deal. So if I have a deal For example, we do a lot of oil and gas deals. If I have deals that are hopefully returning capital within 2 years, 2.5 years, that significantly reduces your risk because you're getting paid right away versus having to wait. So every dollar that comes in is $1 of mine that's coming back. That is, it's less time that it's out there. So I think one thing, cash flowing investments are a big deal. We are looking for great returns, but we're just looking to say, instead of home runs or things that are just off the charts, what do we know is going to cash? What are things that people are looking for now? And as an investor, I like having options. There's times where multifamily is great. There's times where, and you guys are doing build to rent. I think it's a great time for build to rent. There's times for, investing in precious metals, which have done really well. So there's different types of things people do. And so we like kind of finding different options that work kind of for those times. So I think, we'll look, obviously there's things of looking at who is the operator, what is the market, what's actually happening right now. But we love cash flowing deals and we love looking at different assets to try to figure out what makes sense for the moment.
Yeah, you know what, Andrew? I remember a debate that Bronson and I had last year, or maybe it was a couple years back. And what's better, right? At the time, cash flow or wealth creation, right? And I think if you picked that point in time, Bronson was right. If you had to pick one, right? Cash flow over the last couple of years has been far superior, and we've seen it right in our own kind of products that we've created, which is current pay. They want, returns of 12, 14%, and they don't care about the big bag. But I still believe in my heart amongst heart, I think that wealth typically can create cash flow a lot easier than cash flow can create wealth. So my feeling is balancing that part of your portfolio with cash flow investments and alternative investments that do have a big pop. And maybe there are opportunities there where you can strip away a lot of the risk. A lot of people on this call probably invested in businesses, or they've invested in franchise or oil and gas. Some of those have preferred returns, but where they make a lot of that money is by larger investors in equity, accumulation and then preservation. So that's kind of what I would say. But I've seen over the last 3 years, as interest rates have gone up, and a lot of the properties that we invest, as you know, Andrew, in the apartment space, the operation was exactly the same. We were operating it the same way. We had the same net on income coming in, same expenses. In fact, we were pretty much hitting our targets, but you've got a rate cap that comes due, and you got to pay that couple $100,000 up to $1.5 million in order to get that rate back where it was, or a yield adjustment, right? Because certain banks want a DSCR, their rate, in relation to the equity, or in relation to the value of that property, that changes pretty dramatically. So I think over the next year, we'll start to see some of that capital coming back, and that would open up maybe some of the rates coming down will bring up some of the capital coming back. But more importantly, the capital comes back when, the flow of money comes back, right? When the flow of money for one person, irrespective of where interest rates come back, then you got more money coming in. So that's kind of where I see the next year or so.
Okay. Hey, everyone, I've got a poll question in the chat. Check it out. Put your favorite response in. Would love to hear what your investing goal is, your top investing goal for 2025. All right, this next question, this is put your expert hat on, and you're advising a potential investor. Here's a question. What are the biggest mistakes you're seeing investors make in today's market, and how can we avoid them?
I can go. Yeah, I think the biggest mistake investors are making now is a lot of people I think a lot of people are afraid. I think there's really two mistakes people make. One is analysis paralysis, where it's like, oh, I don't know what to do, so I'm not going to do anything. And the challenge with that is that you miss out on opportunities, you miss out because of inflation, because of other things like, oh, I should have done this, or I had the idea, but I didn't do it. So that's kind of one side of the coin is basically the inaction or the inopportunity of for example, I think right now, multifamily is a great opportunity. We're at 2016 pricing in a lot of scenarios, but it's hard to get investors excited about multifamily. Literally, we've tried, and people just don't get excited about it, right? Or they've had losses of other things there. But sometimes the best time to invest is the time where everyone is afraid. So it's that whole Warren Buffett, be fearful when others are greedy and be greedy when others are fearful. So that's one side. The other side is, for investors, instead of just, sitting on the sidelines, maybe, people are just, again, going with what they know, right? So like, oh, I only do this one thing. All I do is I invest in stocks, or all I do is I invest in debt funds, or all I do is I invest in this one thing. And a lot of people are active in their business, or they're active in their investing, but they're not really continually learning and talking to people and trying to figure out ways to grow their wealth, outside of kind of what they normally know. So I think that's why, I just love having conversations with people doing all different types of investments. Because like I said, there are just different times where things make more sense than others. So I think, kind of to Andy's point, when people, when rates start coming down, things like that, real people are like, man, I wish I was in more real estate. I wish I owned more stuff, even at higher interest rates now, because that stuff starts to become much, much more attractive over time. So I think those are really the two things: the analysis paralysis, or kind of doing what you've always done.
Yeah, that's good. I think that typically where I've gotten into trouble in my past life, and I think that this is part of human nature, is we all kind of think about those losses, right? That's my dad was a college basketball coach, and I could ask him about any game, and if it was a win, he probably didn't remember much about it, but if it was a loss, he could tell me every single thing that he had, because you spend up time on tape and all the rest of it. So I think what happens is sometimes we get so shook by a bad deal that we're really afraid to get back in. So I think that what Bronson says makes a strong point. The other thing is, we're not saying when we talk about alternative investments that this is the kind of sole investment that people should be looking at. I mean, the market in general has been pretty strong, and I think a lot of people are concerned, right? There might be an AI bubble, but I still think that 120 rule makes sense, Andrew, and that you subtract your age from 120, and that would be the allocation that you'd have kind of in the stock and alternative investments, and then maybe the balances in bonds or other kind of low yield, safer investments. I think that's still fair, but I think that what people are sleeping on a little bit is that traditional 8 to 10% that people are used to seeing doesn't allow those same benefits that real estate or alternative investments allow, because people consider that 8 to 10% over the last year, over 100 years, in a 10-year period, et cetera. But what they fail to talk about is what Bronson was referring to, is that, look, you get the depreciation part. That's another couple of points, right? So that 10, 12% is another couple of points on your return. And then you've got appreciation, right? That's another couple points. And then you got loan pay down, and that's another couple. So all of this money that you're using as the bank's leverage point can get you to these other places. On oil and gas, you can invest in things where you've got, writing off all of your active income. So I always tell my wife that I'm a huge catch, because I am a real estate professional. So she can write off all of her active income against my, and I mean, she doesn't believe that I'm that a catch because I'm a real estate, but I believe it. So I don't know, Brian, are you, if you turned off let's give you another shot here. I'm sure you got a lot of thoughts on this.
I should be on Wi-Fi now. I'm back to the hotel, so sorry about that,
awesome.
guys. But I want to just basically continue Bronson's thought. And what I wanted to share on this thing is, it's basically the chasing of returns. I started investing in self-storage in like 2013 and buying at like 8, 9, 10 caps. And that worked out super well. But after a while, it gets hot and people are making money in self-storage. I want to pile in. And so eventually it gets, the cap rates compress, right? Because everybody wants to get in that asset class. So people dive in when it's at 5 and 4% cap rates, right? And all of a sudden they're not making very much money, because they're chasing those returns. Same thing like NVIDIA. You could buy NVIDIA. People, when it goes up, they buy at all-time highs. And then in April, when it fell to 90, right, nobody wanted to buy. Everybody was scared. And so it's basically doubled since April. And anybody here on the call could have made that investment. But it takes guts to basically go against the storm and try to bet on what's next versus what's worked in the past. So it's always, my point here is, investors are chasing what's worked as opposed to trying to figure out what's going to be next and where they're going to get the best returns in the future.
So Brian, you've got a lot of investments. I'd be curious to hear how you allocate, you know, opportunities, because you invest in a lot of different things. I'd be curious just how you kind of look at it and how you recapitalize maybe the allocation each year. How do you
Sure.
do it?
I try to keep a balance. Like I'm trying to basically um, develop financial independence from basically from private equity, from a single family rental portfolio, from multifamily, from syndications, from hard money loans, right? So I'm trying to build these like 8 pillars of income. And I don't always just, I don't think about it like in a stock market where you want to reallocate every year and balance, because you really want to go where things are working, right? And so recently I've been doing a lot of flex industrial. Why? Because I can get 10% cash on cash, right? I can't get that anywhere else. And I bought a lot of flex industrial. So I haven't been like this year, I'm not saying like I need a little multifamily, I need a little self-storage, I need a, right? It's like, hey, this asset class is working. So basically right now, that's where I'm deploying. When that stops working or when that gets compressed, then I'm going to transition elsewhere. But I really want to be where the opportunity is, and not chasing the opportunity where the opportunity was, but where it's going to be.
So that's good. Let me transition that in this next question because I think it can really relate. So interest rates, inflation, there's still some uncertainty. We think we see where it's going, but there's still some uncertainty. How are you evaluating these different opportunities now compared to say 3 to 5 years ago when things were very different?
Go ahead, Bronson.
Yeah, so I think oh, sorry, to evaluate opportunities now. I mean, I think that there's things that really don't change. You know, you really have to look at the framework of what is the market that you're investing in. There's real estate markets. Somebody will ask, well, how's the real estate market? And I'm like, well, what do you mean? Single family, multifamily in LA and Arizona, in the city, in the suburb? What are we new stuff, old stuff? So getting specific on what the market is. So for example, we recently did a self-storage deal. To Brian's point, we did a self-storage deal in Houston, Texas. And so I want to look at like what is the market for self-storage in Houston, Texas, right? So that's kind of something that doesn't change, right? It will change in the market, but it's just something you always want to look at. And it could be what's the market right now for oil and gas? What's the perspective? What's the need going to be over the next 2, 3, 4, 5 years? And so you have to kind of look at whatever asset you're invested in. What does that market specifically look like? Then we kind of go down to who is the person who's going to be doing this? Who is the operator? And is this a one-off thing for them? And we even find people that have done multifamily for years in one market, but yet they're going to a whole new market. And that's the kind of a different deal, right? They have a different property manager, different, contractors. And we've seen people do really well in one market, but have trouble being in a different market, right? So we've got to figure out who the group is this, and then hopefully it's a rinse and repeat type of deal. And then after you kind of figure out, that your values align, who that person is, then you come down to, what does a specific deal look like? And does this actually get you closer to your goals? If you're a high earner and you're making a lot of money, maybe you're paying high taxes, you're a physician, maybe reducing taxes is really important to you, right? So, or, finding ways to replace your income by having cash flowing investments. If you're somebody who's got enough money and you're kind of like, I'm just kind of trying to figure this out, maybe some sort of long-term buy and hold or higher, wealth preservation type of things are better. So I think it's good to kind of figure out what you do. I think some of these are timeless. I think right now, like I mentioned, the things that we're really excited about, we love buying businesses. We like real estate debt funds because they do produce cash flow and they're at a safer position. A lot of people have just been really excited about getting to a place where, we're getting paid in some ways like equity was a few years ago without taking the amount of the risk that we were before. And then also, we're actually doing a modular home building project in Southern California, where they build homes in factories, up in the high desert and put them on trucks and bring them out and assemble them in one day. And these are full 2,000 to 3,000 square foot houses. So I think that, just being opportunistic and finding out kind of what the opportunity is. Not every opportunity exists forever. This is like a game where the board continually changes every week, right? Everything looks a little different. And so it's figure out right now what makes sense. So those are some things we're excited about as the steps we go through to vet deals and vet sponsors.
Hey Andrew, let's give Bronson just an opportunity to cook a little bit on the modular. I'm so fascinated with the subject. We've been developing in the South, and it just hasn't made sense for us at this point to turn over some of our construction to I think if you say modular, sometimes people get turned off. So off-site housing. I'd be curious to just let you cook a little bit and hear kind of how you see it. Where is it working? Where will it be going? How can people get in on this option?
So I started looking at it when we had the fires here. We had really big fires January of this year, 2025, and we had over 20,000 structures burned. So where I live right near Altadena, which is it's up near the mountains, and we had at least 6,000 single family houses burned down. And so it's really tragic. And I was like, what can I do to help? And I realized that one of the big limiters is construction costs are just crazy. And in general, in LA, things are just expensive. Labor is expensive. Everything's expensive. So I started looking at what are some options. And I'm hearing people being quoted on build costs of $800 to $1,000 a square foot. I literally talked to a guy at the golf course the other day. He was saying this is kind of what people are paying. And we're seeing modulars. You can get them for $200-300 a square foot, depending on how high end you go. But it's just so much cheaper to build in a factory. And it's kind of hard to, like, people think of modular thinking like, is this like a mobile home? Like we saw like 50 years ago, like a mobile home park? And the answer is no, it's not. It's actually different. These are homes that basically they do put them in sections. So they'll build kind of multiple sections. They'll put them on trucks and they can assemble them in one day on site. And so, the biggest thing is speed and cost. Those are the two things that we really get out of this. Instead of taking maybe a year to build and having 22 subcontractors, all we need is one general contractor, a subcontractor kind of pour all of the foundation, the slab. We need somebody to connect the utilities, and then you need somebody to kind of go in and touch up that there may be some of the drywall cracked when you show up, so you have to kind of touch that stuff up. So, but it's basically fully made somewhere else. And these are things you can basically have, granite tops, you have hardwood floors, you have really nice bathrooms. So it's not like you'd walk in and just say, oh, this kind of looks like a piece of crap on wheels. It's like this actually looks like a nice custom home, and it actually it will sell for about retail value. So we just see opportunity like that, where it's like, hey, if we can do something like this, where we're in an area where there's it's an arbitrage, right? We're basically taking labor and we're basically doing it somewhere else in a much cheaper setting in a factory and being able to put it out. So we've been pretty excited about the opportunity.
Cool. I'll let Bryan take Andrew's question on interest rates, and then I got a follow up.
I mean, the big thing is to be as careful as possible, right? The biggest thing is when you're evaluating an investment, what is the debt? What does it look like? I just passed on a deal. It had 5-year debt on it, and then there's a balloon, right? And they're like, oh, we'll be out of it by then. But will you really be out of it? Do you know that for certain? So really looking at debt terms has been one way where I've been trying to figure out how to reduce risk, really figure out what are the risks, right? The danger is thinking the world is always going to be the way that it has been. I mean, that's what got a lot of operators in trouble in 21, thinking, just because the Fed said interest rates were going to be low for a long time doesn't mean that they were actually going to be low for a long time. And so anticipating what could go wrong. What if this takes, instead of 5 years, it takes 7 years, right? But your debt's due in 5. What happens if you can't turn the units and do your value add in 18 months? What if it takes you 36 months? What if you're bleeding $100,000 a month? Those are all the risks that you have to analyze in this new market to look at, is there more risk than it looks like on the surface?
Yeah, you know what's interesting, Andrew, when I remember 2008, when the music stopped for everybody, it was not what people would have thought, right? There's always this kind of black swan. I think there was people probably predicting that we're obviously doing too many adjustable rate mortgages, but no one really would have predicted that no lending would occur, right? And basically for the additional 3 years, right? 3 or 4 years, we started to see the market come back. So the way that I've started to view things, or been viewing things for a long time, it's not just me, it takes mentors and teammates, is for those things that you cannot account for, and that's interest rates, that's a black swan event, that's oil prices, there's labor, right? If we can't get our construction projects because there's ice, whatever that is, there's got to be multiple exit strategies, whatever business that you're looking at. So for built to rent, that's where we feel we have an unfair advantage. For most people on this call, there's a business that you work in that you inherently understand a little bit better, have a nuanced understanding than other asset classes. For us, that's the built to rent. And so what we try to do is, when we're developing these projects, if the loans dry up, if the capital markets dry up, we've got individually platted homes that at that point we can decide to rent, hold, or sell. So I think as it comes into options, I was at a conference last week where people are trading a lot of options, right? They've got their stop gaps and they've got their exit strategies, and probably the most important thing here, and Bryan mentioned to it earlier, is that they understand the human fallibility of, oh, more, or greed, or I can get back, or I can chase. And so that's kind of going into this season of time where cap rates are starting to compress, values will go up a little bit, flow of capital, there'll be a lot more deals, but there'll also be a lot more competition. So I think you need to account for things that we have not experienced yet, or maybe we experienced many years. I've been through 3 or 4 cycles. Each one was a little bit different. And yeah, it's easy to go back now with that inflection point and say this is why it happened in 2000, the dot-com bubble, or 2001 after 9/11, or 2008, or even 2022. But they all had some different element to it that was a little bit unpredictable.
Hey, if you guys, anyone has a question, please pop it in the chat. We'll monitor that and make sure we get your questions answered throughout. Speaking of trends, where do you see smart money? You know, when you hear the term smart money, where's the big money moving? Where's it flowing in 2025? And we've heard a number of different trends and things that you all are investing in, but what trends should investors be watching more closely?
Bryan, why don't you start us off? Oh.
Go ahead, Bryan.
Sure. Actually, one of my favorite podcasts is a show called Dumb Money, which it's the play on the smart money. It's supposed to be Wall Street money, but the retail money can actually end up making smarter decisions sometimes, because you'll find sometimes Wall Street will chase itself. From a public market standpoint, obviously the AI play is still huge. Again, you have to be careful that you're not chasing the trend. You want to be on top of that, in front of that. There's definitely money be going into there in the whole, but then that whole chain, not just the chip makers, into rare earths, people with data centers. So that may be a real estate play that, you can buy an investment that's buying a data center, right? And so you own that real estate that is going to be now in demand. So definitely smart money is looking for the trends, but as far as that big thing, as far as Wall Street, they're still out there. I mean, they're looking for opportunities. I heard a big webinar from KKR, which is a big firm on Wall Street, and their premise was that when commercial real estate has fallen 20% recently, and when you historically have done that, that's the best time to buy. So again, kind of my point earlier, is like when people are scared is the time you want to move. As long as you can see the future and that there's upside, but definitely it's kind of the Wayne Gretzky thing, trying to skate to where the puck is going to be instead of where it's been.
Yeah, Bronson.
Yeah, I agree. I mean, I think, right now we just in general love things that are out of favor. I was an investment advisor for a few years, and you get to see the Wall Street Madness. It's all about chasing short-term returns, right? What's happening this month, this quarter, and Wall Street really has a hard time with things that are longer than 1 or 2 quarters, right? It's hard because they have investor, feedback. They've got to get such immediate results. And so we look at things that we feel are out of favor. I mean, I look at, we've kind of ridden precious metals up just personally. It's not necessarily an investment, but a store of wealth. Instead of holding cash, I've held my money in metals, and now stuff's basically tripled from when I bought 5 years ago. That's been incredible, right? I'm really happy about that. Another thing, commodity prices. So I'm looking at oil, and I'm thinking OPEC is kind of trying to flush a bunch of, production out there. But eventually, I mean, how is everything else is more expensive, and gas prices are $5 a gallon almost in Southern California, but yet, oil is less than $60 a barrel, right? So I kind of look and say, well, what's not sustainable? That doesn't feel very sustainable to me, right? So there's some opportunity there. I think that opportunities are everywhere. If you're willing to look, you're willing to be patient. I think it just depends kind of what your goals are, because then you can have a great opportunity that's going to make a lot of money someday. But it's like, well, where do I want to be? I had a friend, actually, to Brian's point about NVIDIA, that bought NVIDIA in 2014. Put $500 in there, and it was worth about 300K now. And then she was like, oh, I'm going to keep it. I'm hoping it'll go up more. And I'm thinking like, well, you have a lot less room to go up when it's the largest market capitalization of any company in the world. NVIDIA has become that. So if it's the largest company, it might go up another 10, 20, 30, 40, 50%, but it's not going to go up another, 40 or 50 times, right? So it's time to find the next NVIDIA. It's time to find the next thing that you're looking for. We have a deal we're going to launch in the next couple weeks. That's a data collection company. It does non-identifiable data collection. It's a technology product that basically with AI, it's getting hard to evaluate traffic on internet sites because of Apple and Facebook. A lot of these groups have changed their algorithm. They've changed how they're able to collect information. And so this is like in busy places in Times Square or busy places in LA or Atlanta or wherever you are. How do they track, how many cars actually go by a certain place? How many people are walking by a certain area? And this will give real-time data. And so there's a lot of people that just really want data. So we have a company we're partnered with that's going to be doing data collection in that way. So it sounds not sexy, but when you realize AI is just based on data and is just so hungry for all the data we can get. So we see that that's a trend that's out there. So I think that it just, you need different things in your portfolio, especially as you become wealthier. So for most people, having pretty, boring cash flowing or, appreciating stuff is great. And then we have some stuff that it could be, a 10x to 100x type of stuff that we know most likely it will probably go to zero, right? But there's a chance that if it does hit the way we think it could, it's kind of life-changing, game-changing stuff. So we kind of look at a variety of those things.
Yeah, I think it's interesting. I was listening to the economist Peter Linneman a couple of weeks ago, and he was asked, "Hey, what's going to make you? What's the stay rich? What's the get rich? And what's the get poor?" And so he said, "Stay rich is housing, right?" And I think that makes sense. We're 4 million units short. I think if you just think about your own life and how real estate works around you, whether that's apartments or built to rent, you kind of understand that people are used to leasing or streaming or renting in this capacity. That the average age of a homeowner now went from 31 to 39, right? So you figure all this spread in between is a lot more relatable to housing. As Bryan mentioned, the cap rates are compressing, and partly because a lot of the smart money in Wall Street is going to these places. Even some of those large home builders like Lennar and places that Warren Buffett's invested $1 billion this last year, and D.R. Horton for some of it in BTR. So I think that just kind of makes sense, right? That you would have this undersupply, and if you pick in the right markets, again, right markets doesn't mean the hot markets, doesn't mean all the Austins and Phoenixes. It means there's ascending markets in each of those sub-markets, right? You've seen a lot of some of those guys get beat up pretty hard because there's a lot of oversupply and there's a lot of, people are filling up their units and then they're getting hit by the next wave. So you got to be really careful about even some of those hot markets. The get rich, he felt, was retail and office. It's really undervalued. I think Bryan hit on it now. Commercial real estate has come down a ton. A lot of guys are requiring folks to get back to the office. So if you just kind of think about it logically, does it make sense that people are going to come back to the office and that New York real estate is going to stay depressed? And in these big markets where businesses are booming and AI is going bananas, you would kind of expect that there would be some office. Now, here's what he said was the get poor: AI and data centers. And the reason is kind of what we talked about before, which is we don't have enough information about where data center. We've got maybe 12 large data companies, right? The Amazons, the clouds, the Googles. These smaller kind of micro companies, there's maybe a couple, maybe there's a play for a couple thousand micro data center, a couple thousand foot micro data centers. You don't know. But we just don't have necessarily enough data to say that supply is really there in line with demand. We know that they're leasing because we've got a lot of the large companies putting in a lot of money into building these data centers, but they're not full yet. So those are the kinds of things that we think about, Andrew, obviously, is to stay rich, and, get poor. And I'm hoping I'm wrong on the data centers, because that would be a huge boom for all of our businesses, right?
I can share one other investment that I've done recently along those lines. And it was basically an industrial park that had been, in order to get it rented, they put a bunch of office tenants in there. And so the building was really transacting at the office cap rate. And the office cap rate, since it's sort of out of favor, was like 8 and 9 caps, right? And the lower your cap rate, the better deal it is for you as an investor. So we were able to buy that building because it was really perceived in the marketplace as an office asset. And then the plan is over the next 2 years to transition that back to fully industrial, because industrial will sell at a higher cap rate. So that's the play. I think I said that wrong. The industrial will sell at a lower cap rate, right? So it'll be more valuable by just changing the tenant mix in the same building. So again, when something falls out of favor, it creates opportunity. And so trying to carefully analyze that risk reward, but definitely not trying to play in the sandbox that everybody else is in. Like to Andy's point, if everybody's investing in data centers, then that's basically going to get bid up and there won't be as much opportunity. The idea is to be early enough that you can do well, like your 2014 NVIDIA play.
Yeah, you know what's
I'd
interesting
love to say
that
one
you
thing.
say about that 1 second, Bronson, just because it hits on Brian's point, is that we saw this 10 years ago. It's kind of like whatever politician said, there you go again. I can't remember if it was Mondale or whoever, but there you go again, which was there's this live work project that we're building, and the rents for the for the just live part of it, cap rates were really, really low. And for the office, the cap rates were really, really high. It's the same unit, same buyer, same user, but the values are completely different. So there's always these market inefficiencies that we see every single cycle. I don't know why we forget about it, partly because there's a new shiny object. In this case, it's AI. I'm not picking on that. I'm just using it as an example. And so you are seeing these things that are cyclical. You go to 2000, 2008, 2020, all of these cycles where you're seeing those market inefficiencies. Sorry, Bronson.
Oh, you're good. No, one thing I love about investing is it's almost as if you are a batter at a baseball game, and you don't just get, you can wait for as many pitches as you want. You don't have to only get somebody. You can literally let anything go by, and whatever sounds good, you can take a swing when you're ready. And so, a lot of really great investors that I follow, Warren Buffett, Charlie Munger, some of these guys, they would say, we don't get paid to buy and sell, we get paid to wait. And so as an investor, I think it's just so important to, to find really what makes sense for you, right? Not to just say, oh, everybody else is talking about this, I should do this, but, really figure out what you understand, what you feel like you like, and what's the premise there. And I always look at like, what's the upside here if things go well, and what's the downside? Like what you were talking about, it's almost like we're taking this asset and we're converting it into something else, from a, more of an office to more of a retail or some other type of conversion. And that's huge because there's a lot of value that's created there. And so we look for things where we can play. So for example, with the modular home deal that we're doing, we can build way cheaper than anybody else, way faster than anybody else, but we're playing the same game that they're playing. So we have two competitive advantages because we can do it, instead of taking 2 years, we can hopefully do it in less than a year. And then basically we can build for half the price. And so things like that, if you're an investor and you can find some sort of, like an unfair advantage, right? Just whatever the asset is, it can always help you. So I just want to make a comment on that.
Very good. Okay, we've got time for one more question. Okay, this is the one that everyone's been waiting for. All right, this is for each of you. You have $250,000. And you have to deploy it today. Where are you going to put it?
Well, I'm going to defer to the two smart guys and figure out where they deploy it. So let me answer last.
I can take
I think
this.
Brian would he'd write a song. He'd write a song about it, right? First.
There you go. And I would keep the publishing rights and the composer share, and I would license that intellectual property time and time again.
And you'd invest from your Roth IRA, so you wouldn't get taxed at all, right?
Exactly. Well, I will tell you at least where I've spent my last 250K or more. I've really been deploying into a lot of industrial deals, flex industrial space. These are smaller warehouses, not the big Amazon warehouse, which can be subject to being overbuilt, but the smaller flex industrial is being sold at below replacement cost. And really what put me on a map as an investor was buying houses in Phoenix 2009 to 2012. And I was buying for 25 cents on the dollar. One of the reasons I felt comfortable doing that, even though everybody else was basically running out of the building, of the burning building, and screaming and yelling, "Don't go in there." And I went full force into the building, right? But one of the reasons that gave me confidence to do that is I knew it cost at least $100 a square foot to build a house, right? In some cases, maybe 150, maybe 200, right? And I was buying houses for $33 a square foot. So I knew eventually we're going to have to go back to at least replacement cost. So on these buildings, I feel good about buying these buildings at below replacement cost. And then there's a couple plays on that. The play that I really like right now is in the way that you could take a condo complex and basically put a condo map on it, then sell off each individual unit as its own investment. Again, the whole complex will only sell for so much, but if you can sell each unit individually, you'll sell for more. So we're doing the same thing with industrial parks, where we'll take 6 units to 25 units and basically put a condo map on that so that each unit can be sold. And just example of metrics, we're buying one place for 150 a square foot, and a retail buyer will buy that so they can own their own office and their own shop, their own basically industrial building, and they'll pay 270 or 290. So that's a way of creating value. So I've definitely been deploying a lot into those. I like low risk lending. Anytime you can be first position, there's opportunities to make 10, 12%, especially in a tax protected account like a Roth IRA, where those gains are going to be tax free. That can be a beautiful thing. But yeah, I think look, those at least that's where I've been deploying a lot of my capital.
For me, I really like I like debt funds right now because I think it's a safer position in the stack, and we like first position debt funds. So a lot of times people do flipper funds or other types of funds, and it's just not the first position. And so we like low loan to value, 50%, 60% loan to value first position, and we just find it's much safer. We're finding stuff to pay 7 to 15% depending on the duration, right? So it's amazing to find that. And so people, and I know people that are working class people that love cash flow and pay monthly kind of stuff, and other people that I know people that are worth 500 million, they love cash flow as well. And so finding ways to do that, that's a big one. I love oil and gas right now. I think it's a great time to get in. I think a lot of properties, even, and I specifically like oil and gas royalty deals, which are more land ownership deals, because you can get such a good deal on the property, and then you own the property, then you can get a percentage of the upside as more drilling is done. So it's kind of a unique way to get into oil and gas, as well as oil and gas drilling deals. And then the other one is self-storage. I think right now is actually a time, if you think about it, it's a depressed time for self-storage because with interest rates being higher, nobody can sell their home, right? People can move, but it's more like people are kind of stuck. And so we're not having the mobility, and people aren't moving like they were. So I think right now, even a lot of the big REITs that have done self-storage have been on hold because they're like, well, we just don't see the asset really thriving right now, even though things are cash flowing and they're doing well. So we like the opportunity there for that reason. And we're just seeing some really unique opportunities in that space. So those are some things we're excited about for this year.
Well, Andrew, I was gonna invest in these two. Part of my, but since they didn't, return the favor, I'm gonna hold my money for the things that I believe in. Although I maybe a song. If Brian wrote me a song, I might pay for that. I think my kids would they would really enjoy hearing me in a song. I think that for me, I think these guys hit on it. It's current pay. I think in general, people like the idea of collecting that. And I think this is the huge opportunity as interest rates have gone up, right? Is that Joe Smith has the opportunity now where maybe instead of getting his 5% over the years, now he's getting his 12%, right? And in a debt fund, yeah, I veer a little bit from these guys in the sense that I've seen a lot of kind of the first position, you're kind of investing in maybe one or two homes. Maybe if it's a larger fund, it's hundreds. But if it's a few and you're investing in something that goes awry, you're usually owning something that went awry. So I like the idea of investing, see if you can, with a operating team that has a long track record, that's offering current pay. I think that there's great terms for those private lending opportunities. I think that's a good play for these days. And then I think it comes back to Bronson hit it. It's like, let's think about in this current state of affairs, even if the market goes a little sideways, is 40% of our country still in 3% or less loans or 3.5% loans. Yeah, so they're probably not moving very often. They probably need storage. Is there still a lot of building in some of these secondary and tertiary markets? Not as much as we should be, right? There we certainly go to Dallas and Phoenix and Austin, some of these huge markets, and then you get 4 or 5 projects behind, you lease them up, and then you got to worry about the next project kind of sucking out your rent. So I think the way I think about real estate is where can we have that unfair advantage? And in every market, there's an ascending market and a descending market in every region and sub-region. And I feel like that unfair advantage for us in the housing, which spreads from micro to macro, is in those secondary, tertiary markets where there's economic growth and where there's population growth. Because those are the two things that typically turn a secondary into a primary or a tertiary into a secondary.
Very good. Well, we really appreciate Bryan, Bronson, Andy coming on today and sharing, dropping your knowledge and what you see and what you're doing now. Bryan, where can people find more about you?
Let's see, bryanemiller.com. I have all my contact information there. You can find out some stuff. I'm on LinkedIn, so Bryan with a Y, BRYANE Miller at LinkedIn. I'd love to help you if you have investment questions. You know, investing is really a very sophisticated game. So the more smart people you can get around you as counsel and giving you advice and wisdom, and as Andy alluded, operators who have a long history, long experience, and a very positive track record are partners that you want to seek after and partner with.
And Andrew, you know, one investment we haven't talked, like these guys have invested heavily in their faith in the people around them. And that's part of the reason that, you know, guys want to be around Bronson, guys want to be around Bryan. They're generous with their knowledge and their experience. And it's just a pleasure to see you two and grateful to be here with you guys because I've seen, you know, I've been to Bryan's place. I've spent a couple of days with Bronson and I just see how they operate and how they help the people around them. And it's pretty inspiring. So thanks, guys.
You're welcome. I'm glad I got back to the land of Wi-Fi. So it is beautiful. I'm up here in Banff, Canada right now. So we went out to a lake this morning and a little late getting back because I wasn't the driver, but nice to join you guys and hope it's been a wonderful hour for you guys.
Yeah. Thank you. Thank you, Bronson. How about you?
Yeah, great to be here, guys. Always love connecting with you for a lot of reasons. Love what you guys are doing in the business as well. And yeah, I have a free guide for people. It's how to use inflation to your advantage. So as we're saying costs rise, if you text the word inflation to the number 33777, it'll send you this free guide and it'll just kind of let you know about what we're up to. But I appreciate you guys having me. This is a lot of fun. Great, always great talking with sharp folks.
And Andrew, I think you share our Built to Rent book on our website, legacyacquisitions.com, and then we're all over LinkedIn. And you know, Andrew's another one of those. We just love. We remember what it was like coming up and how hard it is. And really, I should say it the other way, how you can't achieve in this business without the help of people that are a little bit further ahead of you. So we really try to reach back if we can, or you know, point you in the right direction if we can't help you directly. So LinkedIn and legacyacquisitions.com.
Very good. All right, everyone. Thank you for joining today. And again, you would love to get on a call with you and just learn about you and your investing journey, where you are now and where you want to go. We've got a bunch of guys that would love to help you here. So hope you have a great day. Be blessed.